Welcome to the last edition of the Investment Gurus for 2021, where we showcase our asset management capabilities at Momentum Investments. If your year was anything like mine, looking back, it's hard to believe how much has happened in the space of just this 1 year, and how fast it has all gone by. This has been a bit of a topsy-turvy year, in which we once again experienced investment markets that seemed to defy gravity and generated great returns, albeit with significant volatility and uncertainty. To some extent, strong and positive market sentiment was a key component that provided the impetus for market returns. Progress on vaccine rollouts, the reopening of economies, and a robust global growth all created the context of a future with potential. Clearly it seems, and I suppose we are all hoping, for a return to some form of normality. But we do live in risky times, and balanced against these pro-growth forces were events that demonstrated the level of risk in the system and just how fragile the global interconnected economy can really be. Just thinking back at the disruption to the global trade when the Ever Given was grounded in the Suez Canal, the growing contestation between the US and China, additional COVID waves and growing vaccine hesitancy, together with rising inflation, give credence to the risks that are all very real and need to be considered. But before we go away for a well-deserved break and return to the opportunities of 2022, it is a good time to reflect on the progress and the achievements within our asset management capabilities. We will hear from our investment professionals on their respective asset classes, how they've performed, and how they are positioned for the year ahead. Our topics and speakers for today are, first of all, Ian Scott, taking us through the fixed income portfolios. Next up, Pelu Manyeneng will give you a brief overview of the listed property markets and our portfolios. Wayne Dennehy will give us an overview on smart beta portfolios and the opportunity set within there. And lastly, Rian Smith will take us through an update on our alternative investments portfolios. I trust that you are looking forward to hearing from them as much as I am. And if you have any questions or want to find out more about what we do at Momentum Investments, please don't hesitate to contact us.
Hi everybody, as we get to the end of 2021, let's have a bit of a rethink around what happened in fixed income markets this year, what is priced into the curves, and what do we see for 2022. And as always, we start with that global context. What is that world of fixed income? We start with the market's expectations for Fed rate hikes. So we clearly have seen that inflation gets elevated in the US, growth is returning, and the market is now basically expecting the Fed to start hiking interest rates somewhere early in 2023. But obviously the market is saying, well, inflation in the US is elevated, maybe the Fed needs to start hiking earlier in 2022, so the jury is still out on that one. So that's the first level. Second level is what's been actually happening in bond markets, in what we call developed bond yields around the 10-year space. Well, we'll say, are we surprised then when we see yields move up? Because remember, so prices fall, yields move up, as the market is expecting higher inflation and higher growth in Europe, in the US, and other developed markets. So that's the second level. Third level is what are we seeing in emerging markets, right? Emerging markets, so typically South Africa, Turkey, Brazil, Russia. Very similar trend. Bond yields have been rising. Why? Because we are seeing high inflation. Inflation in South Africa is around 5%. Think about it. In Turkey, inflation is about 20%. Are we surprised that we have elevated bond yields? So bond yields are going up, prices are falling in emerging markets as well. So that is the environment. So remember, we've been in a very flat, low environment. We're going out of that environment. Remember, interest rates moves in cycles. So we are definitely moving to what we call the upward movement in interest rate cycles. So what is being priced in the South African market? Very interesting. So the repo is still at 3.5%. And the jury is still out. Will or won't the SARB hike rates at the end of November? And how much of interest rates or how many interest rate hikes will we see in 2022? I think there's still a bit of a dislocation between the market and the SARB. So the SARB is talking hawkish. And that's why we see market rates moving up. So the repo rate is flat, but the market is saying, look, there's going to be high interest rates somewhere in 2022, 2023 in the South African market, and we have to price for that eventuality. What does that money market curve look like? So this is important. This is what we call the term structure of the bank funding curve. It's still very flat. So it says to you, look, growth in South Africa is not going to surprise on the upside. We think inflation is fairly contained. But somewhere in that 1 year to 5 year space, we see that rates are elevated. And we think that the SARB will hike interest rates, let's say in the early part of 2022. But how large that cycle will be into 2023? Well, that's where there's a big dislocation with the market at this point in time. So if we look at it, and there's a thing called the FRA curve, the forward rate agreements, and that's basically the market's forward expectations of interest rates in South Africa. What does it mean and what does it say at the moment? It says, well, the market thinks that the SARB is going to be very hawkish around interest rates over the next 2 years, and there will be about 3% of interest rate hikes out to the end of 2023. Now, we think that's very overdone. Yes, the SARB will hike rates, but we don't think the South African economy can actually handle 3% of rate hikes. We think, yes, the SARB will hike, but they will probably hike around 150 basis points odd into 2023. Right. So let's move into the next market, what we call the credit market, the listed rated market. So what's happening in that credit space? So typically this is issuance by issuers, that's non-government, typically banks and corporates and parastatals. And there's about 120 billion that's probably going to be issued this year. We think there's going to be a little bit more than last year, which was probably around 90 billion. We obviously had a massive year in 2019, around 170 billion of issuance. So this year we found that corporates felt a lot more confident. They came to the market and said, look, we're quite happy to lever our balance sheets, and we are happy to take on some more debt on the balance sheets. What's been happening to the pricing? Now we're looking at what we call bank spreads. Now you see those curves move down. What it means is, remember when yields fall, prices go up. So we are seeing that the price of debt, of corporate debt, is actually very expensive in South Africa. So not a lot of opportunities. So we are saying to clients, look, be wary before you invest in any credit. There are risks, there are high price risks in the credit market. So we're a little bit wary of the credit market at this point in time. If we move on to government bonds, now government bonds is our most preferred asset class in South Africa. Why? Because we think the valuation looks very attractive to us. So what did we see the curve do this year? It's quite important to understand this. So we've actually had a very interesting move that the curve flattened, what we say. So two things happen. As inflation rises and there's the expectation that the SARB will hike rates, the front end moves up. But because we see that growth will be tapered because of the expectation of rate hikes, the long end falls down. And we've had a better fiscal budget. The medium-term budget was better than expected in October. And now we can see that the long end says, well, we think government is not going to borrow as much from the market over the next year. So there's going to be less bonds in the market. So the yields can fall, so the prices can go up. Now that's good for the South African bond market. And we think that will continue over the next year or more. So if we look at what we call the South African government bond yield, right? That's the term structure of the South African long bond profile. It's still very steep. So I said to you it can come down, and it did come down in 2021. But we think there's a lot more that can come down in 2022 and even in 2023. Why? Because it's pricing for so many bad events. It's pricing for a bad fiscal story out of government. Now it looks like the new Minister of Finance is sticking to his knitting of being very prudent with the fiscal policy. It looks like growth over the next year or two will be around sub 2%. So that's not great. So remember, that's a good thing for bonds, right? So we think that curve can flatten over the next 2 years, which will be good for bond funds. If we then look at the valuation, and there's a way that we build it up, and we look at where's US Treasuries and where's our sovereign premium, where is the expectation for the market on inflation, plus a little bit of what we call a supply premium, we can see that currently, if we look at this model, it says, well, the fair value or the price that you should buy South African bonds should be around, call it 8.5, 860, right? Yet that bond is trading around 9.5% at this point in time. It means it's cheap. Even in 1 year's time, we're saying to you, we think the fair value is around 9.25%. It's trading at 9.5. So to us, it says it's a very good place. It's safe to buy South African bonds you're basically getting paid to buy duration in your portfolios at very attractive levels. If that model said to us, the 10-year bond yield is at 7.5%, we would have said to you, that is expensive and we would not be buyers of bonds. But now, at 9.5%, we think South African bonds is a good buy into portfolios. If we move on to our second preferred asset class, South African inflation bonds, what's happened to them? Remember I said to you, there was a lot of volatility when I showed you that graph around emerging markets. Bonds move up and down because currencies move up and down, and the commodity cycle moves the currencies, which moves the nominal bonds. We've seen the inverse happen to inflation bonds, where they've actually been very, very stable to trending down. Two reasons, right? The first reason is as inflation rises, more investors want to own inflation bonds as protection. And the second part was as you get this fluctuation and currency volatility, investors want to rather own inflation bonds than nominal bonds. So we are not surprised to see that there's a strong rally in inflation bonds in South Africa. And we still think it continues. What does that curve look like? Once again, the term structure of South African long-term inflation-linked bonds, still very steep. So in South Africa, typically, your inflation curve would be very flat. At the moment, it's very, very steep, meaning it's pricing for a lot of negative news around inflation, Eskom, bad government finances. We think that is overdone, and we think there's good opportunities in South African real bonds. When that opportunity sits around 4.5%, we really think that locking some 4% real yields into a portfolio really makes sense for investors over the medium to long term. So what is the type of returns that investors in our funds can expect over the next 2 to 3 years? And as always, we start with inflation. So you probably heard from Sanisha. She thinks inflation will probably be around 4.5% over the next 2 to 3 years. So that's the peg in the ground. And we said to you, the SARB is only going to hike rates very slowly in 2022, 2023. So you're going to wait a long time sitting in cash before you get a real return. And remember, a real return is after inflation. So we think cash will give you that 4.5%, maybe 5% return over the next year or two. So, and after fees, it means you may not even have a real return. Yes, you could go up to the credit market, which gives you this 5.5% to 6% return. But look, we said to you, prices are very high in the credit market and there's default risk there. So be careful just to go and sit in the credit market. The two preferred asset classes remain inflation bonds and nominal bonds. Now, at this point in time, we can't say to you rather be in nominal bonds versus inflation bonds or vice versa, because we don't know which one will outperform. But what we will say to you is that rather own both asset classes, rather be in a flexible income fund or a multi-asset income fund that owns both nominal and inflation bonds. And we think returns around 8.5% to 9% is very possible without stretching our valuation models. And look at that. If you can get 9% from bonds and inflation is around 4.5, to get 4.5%, 5% real returns from bonds, we think that is very attractive for investors. I think it's been very clear that over the last year, investors invested in nominal bonds and inflation bonds have been rewarded handsomely by the returns that we have seen. So yeah, good luck out there. Markets are tough, but as always, we look forward to seeing you in 2022 with all the happenings in the market. Thank you.
If we cast our minds back to 2020, we'll remember it as a year marked by major challenges for the global economy and consequently for the global real estate sector. As lockdown restrictions were enforced in most countries, retailers selling non-essential goods were forced to close their physical stores, while corporates moved their employees to remote working environments to protect them against contracting the virus. The natural result of that sudden halt in trading and economic activity meant that some retail, corporate, and industrial tenants could not generate sufficient cash flows to honor their rental obligations. If you fast forward to the first week of November 2020, we saw renewed hope for economic activity across the globe, with several biopharmaceutical companies announcing that their vaccine candidates demonstrated efficacy against COVID-19. To date, we have seen a ramp up in vaccinations across the world, resulting in a significant share of populations being fully vaccinated against COVID-19. Having said that, the rate of vaccinations differs by country, and that has a bearing on the overall recovery of those economies and demand for real estate space. We are seeing developed economies with higher rates of vaccinations showing improved demand for real estate space, while developing economies with lower vaccination rates are lagging in that recovery. If we revisit the performance of the South African listed property sector for the 10 months ended October 2020, we saw a sector that incurred capital losses of approximately 51% over the period. However, we saw a strong rebound in real estate equity markets globally and locally from the beginning of November 2020 on the back of positive vaccine developments, and that rally has largely been carried over into the 2021 calendar year. With that, we've seen 4 consecutive quarters of positive returns from the South African listed property sector, resulting in total returns of approximately 30% year to date. There is a huge margin of outperformance relative to other asset classes, indicating that the sector was oversold throughout most of 2020. On the ground, we saw the development and acceleration of a few themes which continue to unfold. I guess some of these themes are cyclical in nature, but others are structural and will inform how various subsectors of the real estate asset class perform in future and the kind of investment returns investors will likely generate from the asset class going forward. One of the key investment debates affecting the office sector currently is whether remote working will affect long-term tenant demand for office space. We think that the catalyst that is required to shape the outcome of this debate is the rate of vaccinations. So in our view, the experience will be different depending on where a country is in respect of its vaccination rollout program and its real estate investment cycle. If you look at global leasing activity, we saw global office leasing volumes increasing by 39% in the third quarter of 2021. Although these leasing volumes look strong, they are approximately 25% lower than comparable volumes in 2019. The read-through for us, however, is that this pickup in leasing volumes provides some evidence that sentiment in some real estate markets has improved on the back of vaccinations and that remote working is unlikely to drive long-term reductions in demand for office space. Some markets, however, will take longer to recover from the pandemic. While we've seen encouraging progress as far as vaccinations are concerned in South Africa, the share of people vaccinated in the country remains low in absolute terms and relative to other countries. As a result, leasing volumes in the South African office market remain at historically low levels, as most tenants are taking longer to commit to space, largely due to the uncertainty that COVID-19 has brought. Likewise, with the weak trading environment that we've seen in the country over the last number of years, corporates continue to gradually shrink their office space requirements with the objective of reducing costs. Judging by some of the announcements from large office occupiers, this trend does not seem to be losing momentum, and that does not bode well for the office market in South Africa, which was already under pressure prior to the pandemic. We have, as a result, seen vacancy rates increasing to in excess of around 15%, which is the highest level of vacancy rates that we've seen in 2003, and pressure has been evident across all property types from P-grade to C-grade properties. Although the retail sector was impacted the most by lockdowns, what has been pleasing to see over the last number of months has been the decent recovery in visits to shopping centers, which has contributed to the recovery in retail sales. One of the themes that has emerged in South Africa since the outbreak of the pandemic has been the divergence in performance that we have seen between some of the retail formats. Shopping centers weighted towards selling essential goods and those servicing township communities were impacted the least and recovered quicker coming out of the lockdowns, given the high proportion of value and non-discretionary products sold in those centers. As a result, we've seen them outperforming regional and super-regional shopping centers, which generally have a higher allocation of tenants that sell non-discretionary goods. In the medium term, we think that convenience and township retail will outperform. The resilience of some of the township retail shopping centers, however, was dampened somewhat by the unrest that we saw in parts of KwaZulu-Natal and Gauteng provinces in July, with Sastria estimating that the cost of that damage could be approximately 20 billion rands. Although most of the listed property companies are insured against loss of income and destruction to properties, some of the independent retailers were not insured and may not be able to reopen their stores once malls are ready to trade. While tenant demand for office and retail space has been interrupted by COVID-19, the pandemic has certainly accelerated the adoption of online-based retailing and structurally accelerated demand for warehousing and logistics space. Looking at research conducted by CBRE, they estimate that between 2015 and 2020, total global retail sales grew by 7% from $12.6 trillion to $13.5 trillion. Over the same period, online retail trade grew by approximately 140% and is projected to grow by more than 60% between 2020 and 2025. So this share shift in retail sales away from brick and mortar retail to online retail is proving to be negative for shopping centers, while acting as a tailwind for warehousing and the logistics sector. As a result, we've seen strong tenant demand for warehousing and logistics on the back of e-commerce penetration and record amounts of institutional capital making its way into the sector. We think that strong rental and capital value growth expectations on the back of positive fundamentals will continue to attract investment capital into the sector in the medium term. However, investors will need to pay close attention to real estate fundamentals so not to end up overpaying for exposure into the sector at a wrong time in the cycle. In terms of fund positioning, we continue to favor property companies operating in countries with higher economic growth projections and favorable real estate demand and supply dynamics. So if you look at our portfolio positioning relative to the benchmark, we believe there's still good value to be had in JSE-listed property companies operating in Australia, Germany, and CEE regions of Poland and Romania, and this informs our overall positions in those regions. In the CEE, we expect the impact of high structural growth in the economy, high consumer expenditure coupled with low unemployment rates relative to Western European averages to benefit retail property companies operating in those regions. So broadly speaking, looking at our investable universe, we expect retail-focused property companies operating in Central Eastern Europe to outperform SA and UK retail property companies in terms of income growth and asset value appreciation. Our entry point into Germany is through a leading owner and operator of business parks, offices, and industrial complexes with a strong record of shareholder value creation. The resilience of this business model was tested during the pandemic, and our portfolios continue to benefit from the robust operational performance from the company, which is translating into strong shareholder returns. We think some REITs and property companies operating in South Africa and the UK face a couple of headwinds, which makes us less excited about those opportunities. As a result, we maintain an underweight positions in those regions. These asset allocation calls have proven beneficial for the portfolio so far this year, with the portfolio delivering good absolute performance and alpha relative to our benchmark. Given the headwinds expected from the South African real estate market, we will continue to favor well-capitalized and attractively valued property companies which operate in growing economies and are expected to benefit from favorable real estate fundamentals. With that, we thank you for your continued support and wish you and your families a great festive season.
Good morning, ladies and gentlemen. We have the next 12 minutes for me to share with you what's happened in SA equities in the last 12 months. And I'm going to do it in three parts. Part one, I'm going to look at what happened in the markets in the last 12 months, what happened in the market in the last 36 months, and what are some of the themes that we've seen play out. Second thing, we're going to look at our smart beta funds and our market cap weighted index funds. And very importantly, how have they performed? And finally, I'm going to have a look at the very, very important topic on ESG and how we think about ESG in our passive and smart beta funds. So if we look at the asset class returns in the last 12 months, what I'm showing on this graph, if you look at the far left in the dark blue charts, is how has the SA equity market fared and how have the various sectors within that fared. And you can see SA equities up around 40% for the last 12 months. And all the sectors up really nicely, and SA listed property up around 65% for the last 12 months. Not surprisingly though, given that it had some real challenges in the year before. In the fixed income space, you can see bonds up quite nicely, and cash. Had your money been in cash in the last 12 months, you've earned less than 4% on your funds. Precious metals not doing too badly, and oil up 120% in the last 12 months. And on the far right-hand side, I'm showing, had you been invested in some of our offshore markets, how has your funds performed? And you can see it doesn't really matter where you were invested. You've had strong returns if your money's been offshore. And really talking to that theme of you need to be well diversified locally, but you also need to be well diversified by having assets sitting in the various offshore markets. And interestingly is that the Rand is actually 10% stronger than where we were 12 months ago. If you look over a 3-year period, you get some of those themes now playing out. You can see SA equities up around 9% per annum for the last 3 years, financials flat. So if you had all of your money invested in our financial stocks, you've earned 0 in the last 3 years. Not surprising though, because with COVID, banks, insurance companies, medical schemes really got decimated. If you roll forward and you look in the precious metal space, gold up around 13.5% per annum for the last 3 years, actually doing better than if you were invested in our own stock market. And gold has a wonderful habit of being a great hedge against inflation in the medium to longer term. And the best example of that, if you look over the last 50 years and you compare the US dollar to gold, and we probably think the US dollar is a very strong currency, probably very strong to most of what we get to see, gold has actually appreciated by 98% compared to the US dollar. Or put differently, the US dollar has lost 98% of its value compared to gold. A great example of inflation. And from a sort of global perspective, you can see that our various foreign asset classes all performing very strongly for the last 36 months, and the rand actually only around 2% per annum weaker over the last 3 years. This is a graph we really do pay close attention to, and it helps us understand whether active equity managers in South Africa are able to consistently add value relative to the benchmark or relative to just buying a capped SWIX or a sort of index fund. And what the graph shows is if the line is above the x-axis, and as you can see on the far right-hand side of the graph, those bars are higher than the x-axis, and that's showing us that in the last 12 months, active equity managers are able to outperform the market, able to add alpha or add value to our clients. And that's certainly not surprising, sort of if one considers that during the extreme market turmoil we've seen in the last 12 months, one really would hope this is the time for active managers to come to the front. And that certainly is what's been happening. But what it also shows you that there are significant periods in time where active managers struggle to outperform the market consistently or struggle to actually add alpha for their clients. And I often get asked, Wayne, why would you buy a capped SWIX index fund, such as the Momentum capped SWIX index fund? If net of fees, I'm guaranteed to underperform the market slightly. And yes, the statement's true, but the fees are tiny, right? So you're only going to underperform the market slightly. And if you look at this graph, it shows you that underperforming the market slightly is going to do a lot better than active management during some of our market cycles. So a capped SWIX index fund certainly has its space in anyone's portfolio. We look at the same graph for SA listed property, and in this asset class it shows that here active management seems to consistently add value for clients, where in the listed property space we're able to consistently add alpha by investing in a more active way as opposed to buying the underlying index funds. It's important that we have a look at again, what is the difference between a market cap weighted or a normal index fund and a smart beta fund? So your market cap weighted, or your, as a prime example, the Momentum capped SWIX index fund is your classic buy the market fund. So you've bought the market and I've got exposure to every share in the market. And if you look in the last 12 months, the best SA equity fund in our market had a return of 72%. The worst equity fund had a return of 3%. That's nearly a 70% difference between the worst and the best fund in the last 12 months. A lot of buyer's remorse if I happen to choose the wrong asset manager. And that's where your index fund really comes romping in. You've bought the market, there's no chance that I've chosen the wrong manager for the last 12 months. And your smart beta funds, they have the ability to actually add alpha, to outperform the market by capturing a particular style. Styles such as value, momentum, and quality. They look active in terms of how they behave, and I'm going to show you graphs that you'll be convinced this must be an active manager, but they're systematic, passive funds in terms of how they actually behave. So really, if you look at it in a simple graph, your active management is where most clients would actually look to go as a first point of call, but they generally have higher fees in that particular space. Your passive funds, or your sort of capped SWIX index fund as an example, is you'll buy the market. Fees are significantly lower, but you're not able to outperform the market. You're buying the market. And your smart beta funds typically play somewhere in the middle. They're not passive because they have the ability to outperform the market, but they're not active in terms of how they behave either. There's not a portfolio manager making active stock calls deciding to go overweight this share or underweight that share. It's more of a rules-based or a systematic process in terms of how it behaves. So when we think about SA equities and what do we want to put into our portfolios, we're adamant that we want to see various styles. We want to see styles such as value, styles such as momentum, or as we call it, trending, and a style such as quality. Those are the three primary styles we want to see in any SA equity fund. And from our perspective, those three styles give you sufficient diversification into your SA equity building block. At Momentum, we have the smart beta funds of value, of trending or momentum. And we've just launched our quality unit trust into the unit trust platform in the last couple of months. And our value and our trending fund, as I'm going to show you, now have a 4.5-year track record. Wonderful portfolios for clients to consider. If we look at our trending fund, our trending smart beta fund, how has it performed since it launched now 4.5 years ago? And in a single word, wow. It really has done exceptionally well. What this graph shows in red is how the fund has performed over the last 4.5 years, and in blue, how the capped Swix index has performed, or how the market opportunity has performed. And you can see the fund has significantly outperformed the market over its 4.5-year time frame. And anyone looking at this graph would be more than fine to have made the wrong assumption that this has to be active management, and this active manager clearly knows what they're doing. It's a smart beta fund, and yet it's managed to significantly outperform the market. On the value fund, it's the same story. Also in its 4.5-year track record, significant outperformance to the market opportunity, but not performing at the same time as what the market trending portfolio has been doing. Fantastic result for clients, and the net result, while similar at the end of 4.5 years, have got there in two very different ways. And that's exactly what we want to put into our client portfolios. Diversification to get a better and smoother result for our clients. So bringing it all together, how do we think about it? Well, if you invest in one style only, you're in for a very bumpy ride. It's going to be a roller coaster ride through highs and lows, and you're going to do well to hang on to that fund through a medium to longer term period. There's going to be times if you're in one style, you're going to start questioning yourself, should I be getting out? Should I be choosing something else? And those kind of decisions made at those points in time are often not your best decisions. So you want to blend in styles. You want a capped Swix fund, you want exposure to value, you want exposure to trending or momentum, and you want exposure to quality. That's going to give you a blended SA equity solution that gives you a much better result through time. I've said it before and I'm going to say it again, don't ever try and time your entry and exit from these styles. The best strategy in the long term is have exposure to the styles and let those styles run through the medium to longer term. Don't make a call that I should now be going overweight value, or now is a great time to go overweight quality. 9 times out of 10, that's going to be a losing strategy to implement. And of course, with our smart beta funds, you now have the ability to actually diversify your exposure even further, but by introducing smart beta or more passive strategies, as opposed to only having to look into various active alternatives. We also have the Momentum Core Equity Unit Trust, which is exactly what I've now just put together for you. This is also a unit trust that has a 4-year track record now, and is exactly that. It's a blend of a capped Swix index fund, the value, the momentum or our sort of trending risk premium, and our quality strategy. It's a blend of those 4 things into one fund, and look how amazing it has performed since it was launched. Significantly outperforming the market and doing incredibly well compared to its peers. And yet it's not an actively managed fund. It's an extremely well diversified fund, but it's a blend of an index fund and 3 smart beta funds. And the final topic is around ESG. And this is such a hot topic at the moment. I literally can't go to any client feedback session or to any client meeting where we don't end up talking about ESG. How is Momentum incorporating ESG into how you run your index funds and your smart beta funds? How are you addressing environmental matters, social matters, and governance matters into your portfolio construction process and how you run your funds? And at Momentum, it's completely integrated into how we run our client portfolios. It's part of our DNA, it's part of our process, it's part of our philosophy. And we tackle ESG on all 3 pillars, from the environmental side, from the social side, and from the very important governance side. And our clients take tremendous comfort that we do our utmost to be responsible investors with client money, and we really are operating at the very market leading edge of how to incorporate ESG into our portfolios. From a global perspective, we're seeing some pretty innovative things happen. We're seeing new indices being constructed that take the universe of shares and then strip shares out based on how they score on these 3 metrics. It's a great theory. I'm not that sure it plays out well in our markets yet because we don't have enough shares to start stripping out a whole bunch of shares. We're going to be tracking some pretty interesting market benchmarks if we take that view. But from a client perspective, you can be very happy that we are at the front edge of this. It's very topical in all of our client conversations, and we're very aware of how it plays into how we run client money.
What a year. Not only are we currently living through a once-in-a-100-years pandemic, which came only about 3 years after a once-in-a-100-year drought, which itself was preceded by less than 10 years by a once-in-a-100-year financial crisis. And not even to mention the once-in-an-era climate crisis brought about by the human impact since the pre-industrial age. As can be expected, these extreme events create a lot of volatility in the global capital markets. This is why alternative investments are must-have strategies in any investment portfolio. From 31st of October to the 12th of November 2021, many of the world's nations joined the 26th convening of the United Nations Conference of the Parties, COP26 for short, in Glasgow, Scotland. The main goal of COP26 was to accelerate action towards the goals of the Paris Agreement and the United Nations Framework on Climate Change. Momentum Metropolitan Holdings is a proud signatory to the United Nations Principles for Responsible Investment. Furthermore, whilst the United Nations has identified 17 Sustainable Development Goals, MMH has identified 5 of these SDGs on which we have a direct impact, namely good health and well-being, quality education, decent work and economic growth, industry, innovation and infrastructure, and climate action. Whilst our update today is not about climate change, ESG, or the Sustainable Development Goals, alternative investment strategies provide us with a unique ability to execute and drive these principles and policies, as well as giving us access to numerous investment opportunities for our investment portfolios. Momentum Investments manages a number of impact funds, which my colleagues have introduced to you over the course of the past year. These funds also specifically speak to MMH's identified Sustainable Development Goals. Our Social Infrastructure Fund was the first investor in the South African Student Accommodation Impact Investments Fund, which delivered its first project in 2019 already. These are 2 photographs of the student accommodation development called Units on Park in Hatfield, close to the University of Pretoria. Development work has also commenced on 2 further projects, one in Braamfontein in Johannesburg and the other in the Cape Town city centre. The fund also made progress in bringing on additional investors in the form of a large South African pension fund, as well as 2 international development finance institutions. The fund was able to make its first dividend distribution and shareholder loan repayment during the course of the past year. Our Diversified Infrastructure Fund participated in a co-investment opportunity into Community Investment Venture Holdings, a large infrastructure provider, as part of CIVH's capital raise, as can be seen in this slide. The business continues to perform well, and the additional capital was raised to optimize the balance sheet and unlock the additional debt facilities to fund growth. The more mature investments in the Diversified Infrastructure Fund, such as the toll road assets such as this one, the N3 toll concession running between Johannesburg and Durban, as well as the Umoya wind farm near Hopefield in the Western Cape. These investments performed as we had expected, with a strong distribution yield of around 13% on both the toll roads and the renewable energy assets. Traffic volumes on the roads improved back to normal levels throughout the year, after being down around 40 to 50% during the hard lockdown. Our Alternative Energy Fund consummated its first transaction in November 2020, which comprised an investment as part of a refinancing package for an equity investor in a round 1 renewable energy project called Karoshoek Solar 1, located close to Uppington in the Northern Cape. Performance over the past year was in line with expectations, yielding a steady 15.5% net IRR. The Alternative Energy Fund has also received its first distribution from this investment. For the impact funds, we are looking to build out the portfolio with additional investments across these 3 sub-funds. The deal pipeline includes more opportunities in the renewable energy, water, and affordable housing space. Next up, our Special Opportunities Fund, which invests in corporate credit as well as the equity positions of unique property development opportunities, and a Special Situations Fund. The fund boasts a 62-month track record, delivering an annualized return since inception of CPI plus 5.3%. As can be seen from this slide, the Special Opportunities Fund is a consistent performer over all the relevant time horizons since inception, underpinned by the credit portfolio's instruments comprising floating rate notes. This kind of consistency is what we are looking for from our alternative investment portfolios to ameliorate the volatility in the global markets. The equity positions are in all various stages of value creation and realization, which is expected to lead to an uptick in performance as these liquidity events occur. This slide depicts the asset allocation at the time of investment with the post-investment yield accrual and uptick in valuations over the life of the fund. Similar to the impact funds and private credit funds discussed earlier, private equity investments also aim to capture the illiquidity premium over the long term whilst reducing the volatility of the investment portfolio. It achieves this lower volatility due to the fact that there is no frequent buying and selling of the underlying investments. The valuations are typically performed on a quarterly basis in arrears, and which typically lags between 3 and 6 months. And lastly, these valuations are typically based on some multiple of maintainable earnings of the company and is consequently less volatile. But private equity investments are not immune to the macro factors, and valuations and deal activity also contracted sharply in the immediate aftermath of the onset of the COVID-19 pandemic. Whereas the public markets bounced back sharply after the low of February 2020, private equity deal activity only started picking up strongly in the second half of 2020, again lagging by roughly 6 months. Investment activity further accelerated strongly in the first half of 2021, when the global transaction value was estimated to be close to $584 billion, setting up 2021 for a bumper year of deal activity. Similar to our global counterparts, South African private equity also contracted sharply in the aftermath of the global financial crisis, both in terms of value and volume, before a strong run from 2013 to 2018. Unfortunately, local factors led to an initial contraction in activity in 2019 already, which was compounded by the COVID-19 pandemic in 2020. Momentum's Private Equity Fund 3 started off well in 2016 with a secondary partnership acquisition, and these early wins demonstrate the uncorrelated nature of alternative asset strategies. Fund 3's returns moderated somewhat, though not unexpectedly, and we were pleased that we had managed to mitigate the J-curve effect relatively well. As mentioned earlier, private equity investments are not immune to the global macro factors, and valuations contracted similarly to public markets, although with a bit of a lag. Whilst public markets bounced back strongly in a V-shaped recovery, our portfolio showed a more U-shaped recovery and is slowly closing the performance gap. We are comfortable that the underlying portfolio companies are fairly conservatively valued at multiples that are significant discounts to their public market peers. We consequently expect our private equity portfolios to continue its recovery as the underlying portfolio companies also implement their respective strategies to optimize their operations to a post-pandemic world. The correlation to the public markets re-established at the pre-pandemic low levels, with a correlation of 0.06 to the Indy, 0.25 to the Aussie, and 0.31 to the Capped SWIX index. Over the past year, the volatility of the Private Equity Fund 3 is roughly 52% of that of the All-Share Index, speaking to the aim of lower volatility of alternative asset strategies. Whilst exposure to alternative asset classes such as impact, infrastructure, credit, and private equity can reduce the volatility of investment portfolios, if there's one alternative asset class that can exploit such market volatility, that would be hedge fund strategies. This slide shows the distribution of returns of the JSE All-Share Index over the last 5 years and over the 10 preceding years. As one can see clearly, a shift in the distribution to have a fatter left tail and a lower peak in the distribution. Such lower peaks and fatter left tail are indicative of higher market volatility. In this environment, hedge funds offer enhanced capital protection, greater diversification, and the ability to trade around negative news flows. Our hedge fund range has had a strong 12 months, outperforming the respective benchmarks over the period. The products offer three distinct risk-return profiles: a cash plus profile, a hedged equity offering, and an enhanced equity offering in the portable alpha strategy, which aims to outperform a passive capped SWIX benchmark. All strategies contributed positively, with the fixed income arbitrage being the strongest contributor for the last 12 months in the multi-strategy portfolios. This performance was not without volatility, as the global inflation outlook and stimulus withdrawal talks created volatility and opportunity across global markets. Looking forward, we expect the global news flow to continue to dominate local market sentiment. For the fixed income strategies, fears around more structural inflation trajectory are bound to create greater volatility, but also more opportunity, as these fund managers are able to take short positions in anticipation of any weakness. We continue to favor these strategies on the back of these wider mandates. The equity strategies also contributed strongly, having benefited from a wide range of factors. The increased volatility was a positive for relative value trading strategies, being able to take long and short positions in the related securities. We saw increased event-driven opportunities, and the strong resources performance favored the macro thematic strategies. We are seeing a shift towards more defensive positioning, favoring ZAR weakness, given the increased global risks, and we continue to hold these volatility-sensitive strategies, ensuring diversification to a range of return drivers going forward. In conclusion, during such uncertain times and volatile times, when these once-in-a-100-year events seem to be occurring more frequently, using alternative asset strategies can reduce the volatility of your investment portfolios and, in some instances, exploit the volatility for the benefit of our investors. Thank you.
I hope that you found the session interesting and enjoyable. Ian Scott relayed our fixed income team's views that the market may be overreacting to inflation, and that global developed market central banks will gradually ease stimulus packages, as well as likely only increase interest rates later. He also shared that bond valuations in South Africa still look pretty attractive on a nominal as well as a real basis, and that investors are effectively paid to put duration in their portfolios at a lower price. After that, Pelu Manyaneng reminded us that the listed property sector has delivered strong returns this year. At an operational level, COVID-19 has accelerated a few themes which continue to still unfold. These include a demand for remote working, but also recently an increased take-up of office space on the back of vaccinations. While tenant demand for retail and offices has been interrupted, the warehousing and logistics sector has attracted record amounts of institutional capital and tenant demand on the back of growing e-commerce penetration. Wayne Dennehy then emphasized how the market rewarded different asset classes and how blending differentiated equity styles can create low-cost alpha-generating equity performance, while at the same time being responsible to our society and the environment. Rian Smith finished the session by reminding us that extreme events can create a lot of volatility in global markets, and that is why alternative investment opportunities are attractive strategies for well-diversified portfolios. During such uncertain and volatile times, when outlier events seem to be occurring much more frequently, using alternative asset strategies can reduce the volatility of investment portfolios and in some instances even exploit the volatility for the return benefit of investors. If you want to find out more about our thinking and portfolios, please do not hesitate to contact us. All the best for the remainder of 2021. I hope that you will have a well-deserved rest with your loved ones. If you are traveling, please do so safely, and I hope to see you all in the new year.